You're listening to the Big Cast, your source for the latest in financial technology. Brought to you weekly by the Best Innovation Group, with your hosts, John Best and Glen Sarvati.
Welcome to another edition of the Big Cast. My name is Glen Sarvati on behalf of the Best Innovation Group, where we like to do cool things with financial technology. And today we've got an interview for you with Lee Wetherington of Jack Henry about their recent study at the ongoing annual survey that they do of nearly 200 credit union and bank CEOs, and you can actually see how the two differ the way they lay out the results, looking at those CEOs' strategic priorities, their key competitive concerns, etc. A great planning resource in my book, and Lee's going to be telling us more about that. Rather than me telling you more about the Best Innovation Group, why don't you just check out our website, big-fintech.com, and you can find out everything you need to know over there. We are busy wrapping up a very busy travel stretch. Was just out at the Innovation Club in person, twice annual event out in Moline, Illinois last week. Some great output from there. I'll be catching up with John Best about that, our grand poobah, next week for an episode that will be kind of tying some loose ends together. I'm thinking that we've got finally the spring conference season pretty much over. While you're listening to this, I may be at the Financial Health Network's Emerge conference. I'm not treating that as part of my travel schedule, though, because it's actually taking place here in my hometown of Atlanta, Georgia. So if you're listening to that now, you may, if you happen to be there, say hi. And if you're not, hopefully I'll be bringing you a couple of interviews that I gather while I'm there. Lots of fascinating new reports coming out and very data-driven, which are the kind that I really like. The Federal Reserve's Diary of Consumer Payment Choice came out recently. And it's interesting that its big insight is the fact that it doesn't have any significant changes to it, which, you know, we always get so excited about headlines when we see massive changes. That's what gets people excited. The output of this study shows a remarkable level of stability in terms of the way people are making their payments. Credit cards, debit cards continue to lead the charge. Cash continues to be a solid third in terms of payment choice. And to me, that's the biggest takeaway, that, you know, there's all this talk about cash going away. Well, it seems to be running a stable, steady trend, not really moving much in the U.S., which, you know, it's kind of comforting to see something kind of going along those lines. There is a significant gap, as you'll see, though, in terms of cash usage between the olds and the youngs, as the youngs call them. And then that may have some implications for further down the road. But we've had several conversations, as we talked about here, with the focus groups and whatnot. The young folks have not fully given up on cash. And I've noticed a lot of geographic difference, too, which is also mentioned in this report, which we will post a link to in our show notes. You should take a look for that. A couple of other ones, more of an academic paper from the Kansas City Fed about stablecoin usage that they dug into. It's not that long of a read, and it's got some good data. I believe it's come from DeFi Llama is the data source that they used. And what they're finding, which is pretty interesting, is that less than 1% of stablecoin usage right now is actually for what we would typically call payments for goods and services. There are exchanges, there are transfers, things like that, swapping in and out of other cryptocurrencies. But, you know, the long promised move into the mainstream still doesn't seem to have totally taken hold. On a similar front, another long-standing report, and I'm just pulling out a piece of paper here so I can refer to it. The mothership out in D.C., the Federal Reserve Board, put out their annual SHED survey, that stands for Survey of Household Economics and Decision Making. And if you go deep into it, I found this interesting in that it really created a bit of a Rorschach test online about the way people interpreted this. You go all the way out to page 56, and it talks about cryptocurrency usage. And it's looking at the percentage of American consumers, or households, I think technically, adults, that are using, or in some way, in any fashion, holding it, buying it, selling it, using it in any way, cryptocurrency. And it shows a time series from 2021 down until most recently, the most recent data, 2025. I'm not sure what the exact month of capture of the information was. And it capped out almost entirely because of using it as an investment all the way back in 2021 at 12% of the population, slid through the crypto winter and is rebounding slightly, but has only gotten back, has not yet made it back to that 2021 high. It's now 10% of American adults are showing some use of cryptocurrency. But to me, what's interesting about that, and these numbers don't add, but those are heavily weighted toward people who are only buying and holding them as an investment. The number of folks who are actually using them to send money to friends and family or to buy them as some type of a standard payment transaction is still in the 1% to 2% range. And then there's some other data that asks why people choose to make transactions through cryptocurrency. That's got to be based on a very, very small sample size, since only that 1% to 2% would really apply. So I'm actually kind of surprised they even bothered to show that chart. But, seeing some of the talk online, some people are saying, well, it's still not that big a number. Others are going, it's increasing. Well, yeah, it's increasing, but still not to where it was in 2021. And yet others are saying, hey, 10% is still a pretty big number when you're talking about the overall U.S. population. And that is true. It's also probably well short of what I would call mainstream. So that's another interesting one. Again, the Kansas City paper and the Shed survey, we'll post links to those. And the other one that came up, and I'm not going to post a link to the full proposal, but the NCUA, which I guess not too surprisingly, given that Kyle Hoffman is now officially on his way out of the NCUA with his successor being named. He can move on to his next appointed role. But he was very focused on getting the follow-up out in terms of how the NCUA would implement the Genius Act. And they have done that now. They've put out a proposal in the form of a 269-page document that gets into that. Think QSOs. That's really the biggest takeaway that I'd come up with from here, is that it's not going to be done through the credit unions themselves, but through QSO subsidiaries is where the actual stablecoin transactions will take place. If you want to be really popular at the Memorial Day barbecues, I'd pull out a copy, maybe print it out, or just show it on your phone, the 269-page NCUA proposal. I'm sure that's the kind of barbecue talk people love to hear. But I have not looked at it yet. But one of the things, and I will post a link to this article in the CU Today, Kian Sureshta, the CEO of Investify, he had a take on this that I thought was quite good. Kian's been a guest on the podcast before, and he suggests that credit unions should think twice before really getting into the idea of issuing their own stablecoin. I think, and I agree with them, there's a real serious question about critical mass, about exactly how much we can expect that to really, is there enough volume within the credit union community, especially when you've got different initiatives starting now. You've got a pilot that's been announced and is in the works at Metallicus. You've got the True Stage effort with TSDA, which we've been talking about before. And then, the real kind of wild card that I thought was interesting, a great kind of laboratory project from St. Cloud Credit Union. And the CEO spoke at NCUA about, and again, they did exactly what Kian's suggesting we think twice before doing, issuing their very own stablecoin from a small $1 billion credit union up in northern Minnesota. So Kian suggesting what he calls, I love this phrase, a stablecoin sandwich, which is basically saying that the credit union's role may be best served to be kind of the bridge to get people's money in and out of insured deposits for the purposes of transactions, in which case they may not even know they're using stablecoin. So that's just a sampling of the variety of things the credit union leaders have to be worrying about right now, which brings us to another key piece of data and the focus of this week's conversation. Jack Henry's annual CEO survey, pulling this all together into the strategic priorities that the credit unions are thinking about. So with no further ado, here's my chat with Lee Wetherington. I'm here with Lee Wetherington, the lead author of the annual study that Jack Henry puts out, their strategy benchmark. And Lee, I think you said this is the 8th year you've tackled this?
That's right, Glenn. 8 years in a row.
Wow. And I mean, we already had a conversation. It was actually technically before the study was released, but you gave me a couple high-level points when we did a fireside chat over at Georgia Tech.
Yeah.
Let me kick it off right here. I find it fascinating because I think it's just under 200 CEOs that you surveyed, leaders of banks and credit unions.
Correct.
And
that's right.
A couple of things that I find interesting. One is to the extent that the priorities, both priorities and concerns, vary a little bit between those two groups, and then also how they varied from year to year. One of the key takeaways I thought was the fact that the shifting, I wouldn't say attitude toward fraud, but the rank ordering of fraud. Can you say a bit about that?
Yeah. So we saw a lot of what were top line concerns and fears at last year in 2025 fall off the map and get replaced by other newer concerns. A lot of that driven around the pace of data strategy, analytics, automation, and of course AI especially. So if you look at we had drop offs in terms of fear, I should say, in terms of fear and concern, we saw drop offs on fraud. We had drop offs and concern around cyber. I think that's because that's a function of two things. One, we are as an industry and have gotten a little bit more mature, have put some more powerful tooling in place, including and especially, by the way, AI on both the fraud front and the cyber front. Of course, fast forward to where we are now, real time, we're talking about Mythos and what that portends for the rest of 2026, and of course, rolling into 2027. And then at the top of what kind of bubbled up nominally as a lot of those fears from last year, other fears from last year, scared about more NIM compression, scared about what was going to happen to net income, scared just generally going into 2025. But then we got a couple of rate cuts. And if you look in aggregate, things turned out okay in aggregate. But if you look closely by asset size, it was a tale of two cities, right? The handful of credit unions above 10 billion really garnered most of the performance gains in 2025. The rest of those performance gains sort of were scattered for everybody below that $10 billion mark and really attenuated quite precipitously as you get under the $500 million mark for credit unions. So I think a lot of things have shifted and what came up at the top because of those other things shifting down in terms of concerns was things around talent acquisition and retention, especially around data competencies. So data science, analytics, people who can do things with AI.
Interesting. The other one that kind of caught my eye, and again, I don't know how much this is different from the year before, but I mean, we hear about it all the time, but I had not seen it statistically show up this way. The priority that's being placed by credit union leaders on attracting younger members. That seemed to be the single top priority. Was that new this year, or has it already been there?
That has been a perennial top three priority for the credit union CEOs in our benchmark over the years. It's a priority that doesn't ever seem to quite go away because it never gets quite solved for. I was taking a look at the different responses by asset size on the credit union side of that question. And what you find is that there is absolute desperation among the smallest asset size credit unions about solving for that need to get younger members in to refresh the graying and dying memberships in those smaller credit unions. It's an existential issue. If you look at those larger credit unions, which, as I just mentioned, performed better in 2025 because of their scale, it's not the dire existential issue it is for them that it is for those credit unions under the $500 million mark. The big disconnect in the survey, which is always interesting for me, the disconnects and the blind spots, is to me, the top line, when I look at our anchor question about what credit unions and for that matter, banks are strategically prioritizing for 2026 and 2027, they're both prioritizing growth, but they talk about it and they think about it in two completely different ways. Banks their number one strategic priority is growing deposits, whereas on the credit union side, again, at a tight number two, right behind efficiency, is this acquiring younger account holders. But again, if you drill down inside of that on the credit union side, it's the smallest of credit unions that are most concerned about that. But if you look at banks and credit unions, they're talking literally about the same thing in two different ways. And what I mean by that is if you're a bank and you're concerned about growing deposits coming off of 2025, which by the way, banks grew their loans at about double the rate that they grew their deposits last year, which is why they're so concerned about continuing to grow deposits. But where are you going to get those deposits? Well, those deposits really are going to come from the lowest hanging fruit there is small business. Small business deposits are about 4 to 5 times larger on average than retail deposits. And what they don't understand is that both banks and credit unions don't understand that those small business owners, micro business owners, a lot of them Gen Z, by the way, are camouflaged in your retail checking account base. And they've been going outside to these third-party payment apps and fintechs to collect payments. And then only one of every $8 collected in those third-party settings ever makes its way back to the credit union or the bank for that matter.
Interesting. Yeah, and talking about saying the same thing different ways, I noticed another thing, competitive threats that were identified. Both fintechs, you identified fintechs and neobanks separately as categories people could point to.
Right.
Credit unions seem to be much more concerned about neobanks, whereas banks, the smaller banks, are more concerned about fintechs. Do you think that's semantics, or is there something to that?
No, it's one word, chime. It's just one word, Glenn. This is a simple one. It's chime. Again, credit unions, net have a retail focus. Banks net have more of a commercial focus. So banks don't think about and are not kept awake at night by chime the way credit unions are. And so when credit unions are thinking about, what is the biggest threat to our retail deposit base, when they look at the fact that now 6% of all new checking accounts are being opened with what's called fintechs, but sometimes neobanks are lumped in there as well. One of the biggest drivers there, entity-wise, is chime. So that explains that particular difference. And by the way, if you look year over year, that was probably the biggest single shift in mindset and in understanding year over year in our survey. In almost every prior instance of our benchmark, when we asked this question about who your biggest competitive threat is, our credit unions would point to community banks, and community banks would point to credit unions. That completely changed. Everybody did a 180 on that.
I noticed that.
They finally woken up. I think that's a function of the Genius Act and this dawning sobriety about the threat that big crypto, not just big fintech, but big crypto, big fintech, these entities that are lining up as the OCC hands out trust charters like candy, they're waking up to the fact, and you see it right now in DC playing out with these last flurry of fights in and around passage of the Clarity Act, which just got through some final markup in committee in the Senate. Everybody's waking up to the threat that stablecoins pose to the deposit base and the entire franchise, whether you're a credit union or a bank.
So I noticed that whole pointing the finger across the aisle and saying, no, it's the banks saying the credit unions and vice versa. I didn't know if that literally had gone down from prior times. I always keep wondering in my own mind, does that really indicate that so much of this is just being whipped up by the trade organizations as opposed to the actual folks on the street? I definitely hear the animosity, particularly from the bank side toward credit unions.
I think you're spot on about that. I think it's certainly distorted and amplified depending on sort of what news cycle you're in and which part of the year you're in. And by the way, I went and took a deeper look at the answer to that question. By asset size in terms of, who's the biggest competitive threat. And based on this last iteration of the benchmark, it's only the smallest of the small institutions that now point to other community financial institutions as their biggest competitive threat.
In both directions?
In both directions. It's both on the bank side and on the credit union side. If you're under 500 million in assets, those are the only entities in our survey that are saying that, oh no, it's the credit union down the street, or it's the community bank down the street that's the biggest competitive threat. Literally no one else asset size-wise, thinks that community financial institutions of any stripe are a competitive concern.
I find that heartening. Scary because it means they have a bigger problem to worry about, and that's what woke it up. But on the other hand, I'm glad to see that maybe that might be kind of receding to some extent.
Right. Sobriety is the first step.
What was that phrase you used? Newfound sobriety, something around sobriety.
Yeah, exactly. Yeah.
Going back to the piece about younger consumers, I remember you told me that, I guess, was it this year or last year at the Jack Henry client conference, you had My Rich BFF.
Yes, Vivian too.
I thought that was fascinating. What were your takeaways from that? Or I'm sure she was trying to spread the gospel to your audience.
Well, Vivian too. We brought her in because we've been reading these tea leaves for a while. The inability for credit unions or community banks, or just generally credit unions and banks, to get Gen Z to the door. Now there's discussions about Gen Alpha. It's a structural problem. It's a structural issue. So, in the spirit of trying to shine a light on that and to get some actual tactical help from one of the biggest financial influencers of Gen Z in the world, her name is Vivian Tu, but she does go by the brand My Rich BFF. We brought Vivian in to do the closing keynote at our Connect conference last year. And by the way, the other reason we brought Vivian in is because if you look at this through the lens of the big wealth transfer that's going on through 2048, that's something like 124 trillion is transferring between now and the next 22 years. 70% of that wealth transfer is going to women. It will end up in the hands of women. And then people hear that and they go, wait a minute, what are you talking about?
Yeah.
Well, it's because men die sooner. Men die before women die. And so a lot of that inheritance immediately goes into the hands of women. So because Vivian is not just, has 10 million followers, mostly Gen Z around the world, and she really does know money. She comes from the street. I should say the Wall Street. That sounded bad.
I was going the other way. Yeah.
No. Oh my gosh. I love Vivian. She comes from Wall Street. She knows money. But, she's also female. So the idea was, hey, if you want to really understand not just Gen Z, but the wealth transfer issue, how to meet Gen Z where they are, Vivian took everybody through the way she literally does what she does. And she says, look, I'm meeting this generation where they are. They want to see real faces that they can trust, talking about things that they don't understand.
My favorite word, trust.
That's all that short form video is, whether it's on TikTok or Instagram or whatever. And she's doing it across all of those social media channels. And she literally stepped everybody in that audience that day through her MO and how she does that, how she structures her short videos, what she puts into them, how she produces them, etc. And the thing that I took away was, my gosh, she's talking about people helping people. She's literally talking about, hey, they want to see a real human face who is accountable and knowledgeable, giving them practical advice on things that they either don't understand or need help understanding what the next step is in terms of, doing better things with their money.
I'm also hearing trusted agent, and it's just a matter of who you decide to assign that role
Yes.
to.
I mean, that is a really big issue now. Trusted agents, Anthropic, I'm sure you heard dropped 8 new financial tools. In fact, the week that Anthropic dropped those 8 latest financial tools of theirs, I was in Manhattan, and they were on a stage with a fintech. I'm not going to name the fintech. And the fintech was one of these fintechs that is basically, a fintech. It's basically a thin wrapper around an LLM. And then they're doing some things that are specific to a vertical. In this case, investment bankers. They're helping investment bankers do what they do faster, better, cheaper. And literally 2 days after Anthropic was on stage with that fintech, they dropped these 8 financial tools. And the 8 financial tools were basically things that investment bankers need to do what they do faster, better, cheaper. So what I'm saying to you is I felt like I saw the destruction of a fintech in real time on stage in Manhattan. This is how fast these things are evolving. And now, by the way, Anthropic more recently, just yesterday, I think, dropped Claude for small business. And if your listeners haven't checked that out yet, they're going to want to check that out because these battles are real. And to your point earlier, the pace is fierce.
I will take a look. And speaking of the fierce pace, so something we discussed just before we started recording, AI or agentic AI specifically, because AI does show up more broadly in the strategic benchmark, strategy benchmark, but it's moving so fast. I forget what your actual survey period was, but
January and February.
So even since then, I mean, we're only talking 3 months out. That's not exactly a dated survey, but I think we both kind of assumed that you'd probably get some different perceptions around, with Mythos and some of the other applications of agentic AI. We'd probably already see some changing perspectives.
You would absolutely see that. We're working on a survey now that we sponsor with Bank Director and Finex Tech, a technology survey, and I totally expect when those findings start to come in the month or two ahead that we'll see the needle moving on all of those fronts. You're right, this is changing really fast. It's also important to qualify. I hate to do this just because things are changing so fast. Yeah. So we did our polling in January and February. That was before we started a war in the Middle East. And so that is also an important sort of qualifier for understanding the relative optimism or lack thereof that has severely shifted since that started. And of course, the oil shocks, the result on the higher inflation now that we're seeing, and the taking off the table of any hope for rate cuts in any reasonable time period.
I remember that I think it's 3 years running now at GAC, when the economics team for America's Credit Union gets up and talks about their forecast, and like clockwork, within 2 weeks, there's some massive event that
just changes everything on the table. Yeah, that's exactly right. Yeah, and I've noticed a pattern across economists at the events that we do, and it's like, hey, can you give your deck to everybody? And they're like, no, we don't want to give our deck to anybody because everybody's so afraid of being, of there being documentation of how wrong they were because of just the volatility of everything.
Have to hide some kind of little time bomb in it where it just totally evaporates after a certain number of days.
Yeah.
So there's a lot of great stuff in this report. We've kind of scratched the surface, but the detail that's in there, this is all freely available, right? The best place.
Yeah,
to your website?
Yeah, we published it in April, and it's not just the top level sort of results in terms of the responses from those credit union CEOs compared and contrasted against the bank CEO responses. We wrote up our best analysis of what all of those findings mean to put them in context, both in terms of coming off of 2025 and what is at least we consider durably predictive for 2026 and 2027. So yeah, all just go Google strategy benchmark. It'll be at the top of the results there. It'll take you there, and you can download the entire ebook. It's I'm not objective about it. It's my baby, but I think it's beautiful, and it's got some really good stuff in there for benchmarking your own strategic planning,
which
for
is
the years
the
ahead.
reason for your timing on this. You try to get it out in time for strategic planning season.
That's exactly why we do it when we do it. You're right. Yeah.
So we'll post the link so people can track that down. I found it to be extremely worthwhile as well. And Lee, always enjoy talking to you. It's not only the insights are great in the report, but it's even better getting the added layer of texture to talk to you this way.
Always a pleasure to talk to you, Glenn. Thanks so much for having me on.
Lee Wetherington, Jack Henry, thanks so much. I particularly love the point that Lee made, because I was really curious about the distinction between worrying about fintechs and worrying about credit unions. I love the point that, he really kind of crystallized that quite well for me, that the banks are worried about fintechs because the fintechs tend to be more focused on small business solutions, which is, bread and butter for a lot of the community banks, and they're afraid about that, whereas credit unions are more focused on retail deposits, and that's where you've got, as he says, basically Chime. It may not even, neobanks at this point may almost just be shorthand for Chime when you really dig into it. So the other one I loved that he made was that the very profound comment he made about the wealth transfer, the great wealth transfer going on. Men die. Women die too, but I guess men just die faster, which means that not only are you transferring wealth, but a disproportionate share of that wealth is actually moving into female deposit accounts. So another interesting thing to think about. Come to think of it, I'm not really sure if I've seen those numbers, what the gender split might look like in terms of, I know we have a tilt toward older populations. I'm not sure what that looks like in terms of male-female. I got to do a little bit of digging. I'm going to ask a few questions around that one. Anyway, with that, another episode of the Big Cast in the books. My name is Glen Sarvati. You can find more about me and my firm, 154 Advisors, by checking out, you can check me out on LinkedIn, and you can check out the Best Innovation Group website, big-fintech.com. Always appreciate if you click through and leave us any comments that you've got about either this topic or anything else. We've got the archive out there on the media tab at the website, where you can go back and listen to our past episodes as well, including interviews we did at the variety of conferences we've attended over the course of the last month or so. NCUA Reimagine, the Nacha Payments, Smarter Faster Payments Conference, and then in the coming weeks, hopefully a few more, including some conversations at Financial Health Network's Emerge Conference. We'd always appreciate it if you subscribe, like whatever they ask you to do on the podcast platform of your choice, which may be Spotify, which apparently is getting all kinds of grief for their new logo, which is now, they claim, was only supposed to be temporary for their 20th anniversary. If people have energy to actually worry about a slight change to the Spotify logo, I don't know, they got more time than I do. But anyway, if you listen to Spotify, that's usually where I track down past episodes. If I want to track down the Big Cast, do it there, do it at Amazon, do it at Apple, or do it right at the Best Innovation Group website, big-fintech.com. As always, we'll be back with more content. I think I mentioned at the beginning, our Grand Poobah John Best and I will be discussing actually some interesting chatter online, particularly on Reddit threads around some concerns about AI, which I was quite surprised when I pointed them out to John. He actually kind of agreed with some of them. It's a rebuttal, but not a refutation. Let's put it that way. And you can hear more about that if you check in with us next week. Until then, thanks as always for listening.
Check back each week for the latest from the Big Cast. Or better yet, we hope you'll consider subscribing for free via Spotify, Stitcher, Apple, or wherever you get your podcasts. If you have questions or comments, we'd love to hear from you. Tweet us at Big Fintech, email info@big-fintech.com, or visit us at big-fintech.com and click on the Media tab, where you can post a comment or check out our archive of hundreds of past episodes. See you next week.